whole life insurance is a fantastic low-risk asset. Despite that, there's still some people who think that you're better off just buying bonds. So let's investigate just how much better off you'd be. We recently released a video that looked at the prospect of cutting out the middleman, so to speak. Don't buy the life insurance policy, whole life or index universal life insurance as an example. Instead, just go buy the bonds directly. And I outlined just how silly it is to try that in the context of the difficulty a retail investor would have purchasing direct issuances of corporate debt, which I assure you is extremely difficult to do. That being said, there's always pushback to this point, basically saying that, well, we could just buy bond funds. And while that's certainly not cutting out the middleman, the idea there is that bond funds, certain bond funds especially, are particularly low expense. So given that lower expense ratio that you'd find in your typical bond fund or even bond ETF these days, wouldn't it make more sense to just do that because you then don't have to pay the life insurance fees, which can be quite high, I assure you. Now, I've been around for quite a while. I have a lot of experience with life insurance. I have a lot of experience with bond funds and all other types of investments that most normal people would find themselves choosing to use for the sake of capitalizing their retirement needs. And while I have a number of opinions on this, let's quantify this in a relatively easy way to understand by looking at some very well-regarded bond funds and seeing just how they do compared to your standard life insurance contract. We're going to start by looking at a whole life policy, a typical whole life policy for us. This may not be typical for most people out there, but if you're going to use whole life insurance as a means to accumulate wealth or use it for a building retirement income asset, there's certainly a right and wrong way to do that. So I'm going to show you an example of what we would normally use in this case for a whole life policy one intends to hold as a retirement income asset. So the details of what we're looking at, they're not super important as far as how all of this unfolds, but there are some people who like to get really lost in data. So for those who love that trip, 45-year-old male, we're going to assume preferred risk class on the life insurance policy. It doesn't really matter much these days if you're standard, preferred, or preferred plus, but that's just the one in the middle, so that's the one we're choosing. We're going to do $25,000 per year put into the whole life policy. We're going to do that for 20 years, then we're going to stop, so there's no more premiums due, and we're going to start taking an income in that year of $44,182. Couple of things to notice. Total cash value column. The cash value in year 20, $822,037. We're going to revisit this in a little bit, but one thing I want to call your attention to. If you've been a longtime follower of the Insurance Pro blog, I thank you immensely for all the time we've spent together. If you're new, welcome. And I'm going to give you a little rule of thumb that we typically use when we look at whole life cash values at retirement to determine what the safe withdrawal rate is. I generally say something like 5-ish%. This $44,182 number happens to come out to 5.38% of this $122,000. So we're right on target as far as something that I would be fairly comfortable with. This income stream was actually solved to last all the way to age 100. We're only going to go out 20 years in this example as we look at bond funds. There's a reason for that. The primary reason is that one of the bond funds we used basically ran out of money after 20 years. So we had to use the kind of worst performer as the setting of the goalpost for our timeline. So just know that when we revisit this whole life policy, we're only going to go out to 20 years after retirement. So a 40-year entire period, 20 years up to the point of retirement and then 20 years after with distributions of this $44,182 number. So that's the whole life policy as it sort of comes together, just so you know the basis of what we're looking at. And we're going to see how well the bond funds compare and compete with this in their efforts to accumulate money and generate this same amount of income. We're going to use two bond funds from two different fund families, but they happen to be some of the most noteworthy, most revered, most respected fund families that are out there. We're looking at Vanguard and Fidelity. So the Vanguard fund we'll start with first. That happens to be the VBMFX. It's the Vanguard Total Bond Market Fund. This encompasses all the exposure to bonds one could ever hope to wrap their hands around in one simple to invest in fund. It has an inception date of 1986. It's been around for a very, very long time, and an expense ratio of an extremely impressive 0.15%. An expense rate that most funds can't touch, don't touch, won't touch, and extremely, extremely low cost bond fund. The fund itself manages $350 billion, making it an extremely large fund. So to set the stage for what we're going to do and how we're going to model all of this, as you already know, we're looking at 20 years up to retirement, then 20 years after retirement. So saving $25,000 per year for 20 years, and then distributing the $44,182 per year for 20 years after that. In order to get real market data information with the bond funds that we're going to be using from Vanguard and from Fidelity, we're going to use the Portfolio Visualizer to look at real data for real years. So we're going to use the time span 2004 to the end of 2024. This is arguably a pretty good time for bonds. This was, for the most part, a falling interest rate environment due to quantitative easing that started in full force after the 2008 financial crisis, and the 2010s were relatively well noted as a very strong appreciation time period for bonds. Now, 2004 to 2024 is a 20-year period. In order to get a full 40 years, what we're going to do is take that 20-year period as the accumulation years. Then we're going to take the same 20 years as the distribution period. So whatever the account balance was after 20 years, we'll simply take that as our starting point, and then we'll start withdrawing $44,182 from it for the same 2004 to 2024 timeframe to get an idea of what real results could have looked like being invested in the fund. Now let's look at what the Vanguard data looks like. As a reminder, this is the VBMFX fund from Vanguard, their total bond market fund. The ending balance after 20 years of $25,000 per year is $691,636. The year-over-year rate of return, given the fact that we're putting $25,000 a year into the investment, comes out to 2.12% per year. So if you put $25,000 a year away and you earn 2.12%, you will arrive at $691,636. For all the hurrah of Vanguard as a company, I kind of expected the results to be a good bit better than they were. $691,000 of cash is not that great, especially when we already know that the projection on the whole life policy is well over $800,000 over the same 20-year time frame. But it is what it is. That's what the Vanguard fund did. Now let's look at some more granular detail on how it did year over year. I want to key in on the 5% line here, largely because 5% is sort of the targeted ideal rate of return of most life insurance contracts, especially whole life insurance. So there are, as you can see from this, 1, 2, 3, 4, 5, 6, 7, 8, 9 years where the fund did basically at or above that 5% number. There were also 1, 2, 3, 4 years where the fund was negative. One in particular was very negative. We all know recent history, 2022 was a very terrible time for bonds. So not a great result there. Everything else falls in between. So, some of the years we did better, less than half of them. We did better than that 5% number, but we were also up considerably higher than 5% on a couple of those examples here. So pretty good. But we also had some negative years, and then everything just kind of falls in between 0 and 5% for the Vanguard fund over this 20-year time frame. Now, this is the chart that looks at the next 20 years, the distribution phase. So we start with that $691,636, and we start distributing $44,182 per year against that initial balance. And here's where we end up after 20 years. $133,107. We are nearly out of money. So after 40 years, 20 years of $44,000-ish of distributions, we don't have a whole lot of money left when it comes to the Vanguard option. Let's now look at the details of the Fidelity Fund. In this case, we're using the FTBFX. This is Fidelity's total bond market fund. Hasn't been around as long, started in 2002, has an expense ratio of a respectable but much, much higher than Vanguard's 0.15% expense ratio. The Fidelity one happens to be 0.45%. So a little more than double the expenses you would pay to Vanguard, you would pay to Fidelity by investing in their total bond fund versus the Vanguard fund. And the Fidelity fund's considerably smaller, $38.9 billion, but that's still a lot of money for a money manager to manage. So not a small fund necessarily, just not nearly the behemoth of the Vanguard fund. Now, I do want to point out that there's a lot of people out there who take a lot of exception to higher expenses, and there are certain companies, like Vanguard, that like to tell you you're pissing away money when you go out and invest with companies that charge you so much more than they do. You might see examples of, if you have $1 million, the difference in expense ratio between that Vanguard fund and that Fidelity fund would cost you $3,000 per year. And if we were to compound that over some time frame, like 20 years, we'd come up with some astronomical looking number of all the expenses that you gave to Fidelity instead of Vanguard, which would have been much, much, much less. But let's look at how the Fidelity fund did compared to the Vanguard fund. Just for reference here, I'm going to remind you, this is the FTBFX fund from Fidelity. So it is their total bond fund or total bond market fund. Ending balance after the 20 years of $25,000 per year, $779,806. Quite a bit more than the Vanguard fund performed at. Year-over-year rate of return, assuming the $25,000 per year investment, 3.19%, which is a market improvement over the rate of return that was achieved year over year for the Vanguard option. At nearly $90,000 more in account balance, the Fidelity fund performs considerably better than the Vanguard fund does over this time frame. And remember, it does that including the expense. So that has been factored into all of this analysis, the higher expense ratio of the Fidelity fund versus the Vanguard fund. So even though there may be some that would tell you lower expense is the better option, as you can plainly see here, if you went the lower expense option between Vanguard over Fidelity, you would have ended up with less money despite paying fewer fees to Vanguard over the years. Now let's look at that same chart, again, focusing on the 5% line here. We've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 years where the Fidelity fund outperformed that 5% sort of benchmark that we've put here. We do have 1, 2, 3, 4, 5. That's one more than was the case with the Vanguard fund. Years of negative returns for the Fidelity fund. And then, of course, everything falls in between. But a few more years with Fidelity hitting above 5%. And let's also not overlook the fact that there are 1, 2, 3 years that are above or very close to 10% as the rate of return for the fund. So results with Fidelity, we knew were going to be better because there's more cash in it. But there's a greater amount of variance going on here with the Fidelity bond fund versus the Vanguard fund. And that works out in our favor here. And when we look at distributions, things get even better there too. So unlike Vanguard, which is almost out of money after 20 years, the $779,806 that we had as account balance by virtue of saving $25,000 a year in this fund for 20 years, and then distributing $44,182 from that account after 20 years arrives at a balance of $416,533. That is a lot more money than would be left over with Vanguard after the same 20 years of distributions at a little over $44,000 per year. So lower fees do not necessarily mean more money in your pocket. This is a point we've been driving home for a number of years now. Just because a savings or investment option has higher expenses does not mean it can't also deliver more value to you. And I assure you, the life insurance examples we're about to look at definitely came with higher expenses than either the Vanguard or the Fidelity fund did. So let's take another look at that whole life policy to see how it would have performed over a 40-year period to compare to what's going on with the Vanguard and Fidelity bond funds. We already looked earlier at this. We know that in year 20, we have $822,037 of cash value in the whole life policy, which is more than both the bond funds that we looked at. It's a lot more than the Vanguard fund. It's modestly more than the Fidelity fund gave us. So $44,182, that's the amount of money that we're going to take from this whole life policy, just like we took from the two bond funds. And once we get down to 20 years out, that lands us right here. We can look at the total cash value in the policy, which happens to be $715,405. That is more. It's considerably more than either of the two bond fund options. But let's not forget this is also life insurance, which means we have a death benefit. That happens to be $933,576. So think about this for a minute. We have options and bond funds, which give us the results that we saw there, with $691,000 accumulated with Vanguard, $779,000 accumulated with Fidelity. We distribute $44,000-ish for 20 years. We end up with very little money with Vanguard, $133,000, $416,000 with Fidelity, which is pretty good. But if we do that with the whole life policy, not only do we accumulate more money over that first 20-year period, but we also have substantially more money. We have almost as much money left over in the whole life policy after 20 years of distributions than we accumulated in the better performing bond fund. It was $715,000 versus $779,000. We have more money left over in the whole life policy, cash value wise, than we ever accumulated with the Vanguard bond fund. And with the death benefit, that $933,000, it's actually closer to $934,000 left over in the whole life policy means that what we could leave to our loved ones is a lot. I mean, more than double the amount of money we could leave behind if we had chosen the best performing bond fund at Fidelity. Now, I know there are some people who will tell us, yeah, but it's whole life insurance. So if you accumulate all that cash, they'll pay you the death benefit, but they'll keep the cash and you don't get any of that for paying the money for whatever. Let's keep in mind what options are on the table here. Option A is all the income that we got in any of these scenarios, but $133,000. If let's say we just die after 40 years. Option B is, again, all the same money, but $416,000 if we die after 40 years. And option C is all the same money, but $933,000 if we die after 40 years. And let's not forget the fact that with whole life insurance, there were 0 years that our cash value went down because the fund we were invested in had a negative return. And that means something psychologically to a lot of people. It keeps peace of mind. It keeps them staying the course. It stops them from a massive amount of anxiety about what happens tomorrow or next week or next month or next year. None of that is something we have to worry about with the whole life policy. It gives us the same income. It performs better cash value wise. It gives us more legacy value at the end. We're even better protected, in a much better position 20 years out of distributions with the whole life policy than either of the bond fund options. The Vanguard option is just about out of money. The Fidelity fund, that one can probably exist for a couple more years, well, a number of more years at the $44,000 of distributions and not cause much of concern. But the whole life policy is in an even better position to do it. So if we wanted to go back, and I didn't, so I don't have the numbers, but if we wanted to go back and figure out, well, if we were only going to go for 20 years, what's the income that the whole life policy could project for us? It would be substantially more than $44,000. So under that scenario, we could have extracted significantly more income from the whole life policy and arrived at the same place the Vanguard fund did, for example. And I want to reiterate, just in case you forgot, all of this assumes all of the fees, all of the expenses, all of the things you don't like, paying somebody else money, that exists for the Vanguard fund, the Fidelity fund, and the whole life insurance policy. It's all included in all of these examples. So all of the expenses that got paid to the whole life policy, which I assure you were much higher, at least in the first several years, than would ever be the case with the Vanguard or the Fidelity fund, those were all part of this modeling. You paid all those expenses and you still ended up with a lot more money. It turns out, in this case, the cost of admission is well worth the expenditure. And while I could leave it right there, I'm not done yet because we haven't talked about indexed universal life insurance, and it is a worthy other option when it comes to the decision to use life insurance as a wealth accumulation vehicle, a storage of cash, and or a retirement income tool. So let's take a look at how an indexed universal life insurance policy might have unfolded under this exact same scenario. So here's the indexed universal life insurance ledger. Because it's indexed universal life insurance, we have to choose an interest rate that's going to apply to the cash value every single year. I've chosen 5.5%. I could choose something a little north of 6 here, but we're not going to do that. So 5.5%, that's the number that we're going to assume is the index credit earned on cash value each and every single year. In real life, this policy will perform based on the movement in an index, which could be much, much higher than that, or it could be lower. So it depends on what happens in the actual S&P 500 for this particular product. So we're assuming all the same things. $25,000 a year is going to go into the policy. We're going to look at where things end up at year 20, and the total cash value in the life insurance policy is $833,363. That's more than everything else we've looked at. It's not considerably more. It's modestly more than was the case with the whole life policy at $822,000. So congratulations to the indexed universal life insurance policy. It happens to be the top accumulator from our projection, but it's not enough more to make a life-changing difference, I don't think. We still distribute $44,182 from the policy, and we do that for another 20 years. That lands us here at year 40. Now let's look at remaining cash value, $1,090,044. That is way more than the bond funds that we looked at, and it's also a good bit more than the whole life insurance policy. And let's not forget, there's death benefit. That happens to be $1,221,244. That is, again, considerably more legacy value than the bond funds gave us, and a couple $100,000 more than we would get from the whole life insurance policy. I want to take a moment to point out to you, in case you haven't done the math in your head already, the death benefit resulting from the indexed universal life insurance policy in this example at year 40 in our example is almost 3 times the amount of cash you would leave if you chose the Fidelity, the better bond fund option, as your weapon of choice here. So there is considerably more legacy value built off the exact same amount of income. And my previous point regarding whole life insurance stands especially so here. We could have technically taken more money from the indexed universal life insurance policy and been just fine. And I'll remind you, just in case you forgot again, that all of this assumes all of the horrible things you don't like, the expenses and the fees that were paid to the indexed universal life insurance policy, they're all included in this example. So yes, we paid more money. We paid more money for indexed universal life insurance. We paid more money for whole life insurance, but we still end up with considerably more cash from those two options than we achieved with either of the bond fund options. And again, indexed universal life insurance does not have a year where cash value goes down because the rate of return of some fund underlying it has gone down. It is potentially true that a 0 crediting year could result in fees being deducted from cash value, meaning that cash value does drop by some modest amount, but it will look nothing like a 5% decline, a 10% decline, a 15% decline, which was a possibility with bond funds back in 2022. And in my experience, the number of years that a rate of return on an indexed universal life insurance policy exceeds 5% are way more than we saw with either the Vanguard or the Fidelity Fund. And the number of years we get 10% is way more than we saw with the Fidelity Fund because the Vanguard Fund never really got there. And while we're on the subject of indexed universal life insurance, allow me to point out to you that for this particular example, the one that I pulled was not exactly the one I would generally recommend to people who come to us looking for indexed universal life insurance. It's an okay product, but it is by no means a leader in the marketplace for indexed universal life insurance products. That being said, at 5.5% being the assumed index credit, I have a high degree of confidence that even this product that I've shown you here would do better than that in real life. That's my subtle, or maybe not so subtle way of telling you, inside the space of indexed universal life insurance, there are a lot of other options that are even better than this, and they would perform, by my estimation, a whole lot better than this would. Now, there's another point to drive at in all of this, which is the fact that we're using a $25,000 per year contribution to whatever the savings plan is, which is not impossible to do with investments, but it's hard to do it in a tax efficient way. It does happen to be the case these days that $25,000 is roughly the number you could get to as tax preferential contribution to a 401k plan, which would also put you in line to making a Roth contribution near that amount given current guidelines or, current limits on tax favorable contributions to 401k plans. But that does mean that you have to work for the right employer who has the right features turned on to the 401k plan. Otherwise, your options to save $25,000 a year tax efficiently are pretty limited. Yes, you could make deductible contributions to a 401k at $25,000, but a $44,000 distribution from a deducted 401k means that your net income received from that is not $44,000. You'll have to pay taxes on it. Life insurance doesn't have any of those things going on. The tax features of life insurance are the same regardless of the product and regardless of your circumstances. If you can qualify for the life insurance policy, you can benefit from all of the things it brings to the table, including its taxable features. That means that all of the income that we distribute from life insurance contracts, be they whole life insurance or indexed universal life insurance, will always be, provided we do it correctly, income tax free. And while you may be quick to point out that you could always pass on your assets inside a traditional brokerage account to your heirs with a step up in basis so they would not incur a tax when they receive them, we can also pass death benefits to most people without a tax implication. So while it's not technically a step up in basis per se, it is absolutely a tax-free transfer from you to them. Now, if you're one of those people who obsesses over fees, you are a boglehead, a huge Vanguard fan because you just can't get over the fact that you might pay somebody else more in expenses and that's just no good for you, you do you. I'm not here to convince you of anything else. But for those who don't like stepping over a dollar to pick up a dime, those that we typically call our clients, well, you can come talk to us because this is a wonderful thing that has many benefits. So if you'd like to know more about how whole life insurance or indexed universal life insurance could be a part of your wealth accumulation or retirement plan, head on over to theinsurancesproblog.com and absolutely feel free to reach out to us.